Chapel Hill Denham has released a strategy update report using the NGX 30 index. NGX, of course, our stock index that's weighted by adjusted market caps, meaning the number of listed shares of a firm multiplied by its closing price and a capping factor. Should be noted, of course, only fully paid common stocks are included in the NGX 30. We're going to focus on the banking sector. Joining us to discuss that, of course, Damilola Olupona, who's an analyst with Chapel Hill Denham. Damilola, you're welcome. Thanks for joining us.
Yeah, thank you for having me.
What's the main takeaway from this strategy update that you folks put out?
Yeah, what we did was we analyzed the companies, the constituents of the NGX 30 index. And we just analyzed to see which company has benefited the most, from a revenue standpoint, and how the index has played out, for investors. And what we realized was the index rebounded strongly. We're all aware of what happened last year. The COVID-19 induced pandemic, weighed on most company earnings. But on a year-on-year basis, the earnings of the companies listed of the constituent, on the index, grew 18% year-on-year to 5.8 trillion naira, which was impressive. And we went further to distill the constituent, to see which companies drove the overall earnings growth. And we discovered that Danksem, Dangote Cement, MTN, and Flamis, largely account for the growth we saw on that front. But then it will interest you to find out that the agriculture sector players, that's Okomo and Presco, they were the fastest revenue growing company, on the index. Specifically, Okomo grew on an half-year basis, grew revenues, by 75%. While Presco grew their revenues, by 52%.
Wow.
So, and but on a PBT basis,
that's profit before tax for our viewers.
Yeah, sorry. Yeah, sorry. On a profit before tax basis, we noticed that Dangote Cement, was the highest, reported the highest profit before tax, about 286 billion naira. Closely followed by MTN. But, in terms of profit before tax margin, we noticed that Okomo and Presco as well, delivered strong earnings on the front. So generally, it was a good half-year for the index. And investors, that track that index, have something to look forward to.
Great stuff. Now, we've got a dividend per share. We just had a chart up there. And specifically for the banks, I want to get into the banks now. What do we have? So we've got GTCO, Guarantee Trust, Zenith Access, UBA. So what, as far as, I guess, on a dividend basis, that makes some of these banks attractive? Walk us through what we're looking at here.
Yeah, it does. On a dividend yield basis, for the banking players, our full year estimate, for dividend, means that most of our banking coverage, will report double-digit dividend yields, this year. But for the chart displayed on the screen, what we have there is the dividend payout ratios, for most of the banks and most of the companies we cover. And we noticed that on a dividend basis, Stanbic was posted the highest dividend in terms of year-on-year growth.
Okay.
I think they declared a 1 naira dividend, which meant a 150%, I think, year-on-year growth in dividend payment. And that was despite the lower EPS, reported over the first half of the year. On an half-year basis, they reported earnings per share of 1.92 naira.
Okay.
But then for the other banks we cover, for GT Zenith, they retained interim dividend of 30 kobo, and which on a dividend yield basis was a 1.3% and a 1.1% dividend yield, respectively. But on a full year basis, we expect both companies to report double-digit dividend yields, which is attractive to investors, especially when you compare that to the one-year Treasury bills, which is currently trading. I think the last auction closed at 7.2%.
Right.
So investors have something to look forward there. And for UBA and Access Bank as well, their dividend were also strong, and we are hoping that this year, for both companies, they will report, higher dividends this year, which is also attractive for investors as well.
Great stuff. The revenue triggers for, if you look back at this half year for the bank, just looking overall, what's What were the revenue triggers for the banking performance you saw?
Yeah, for the banking performance this year, on an aggregate level, earnings revenues were not very strong as we saw change in market dynamics this year. You recall that last year what we had was the lower interest rate environment, which meant that most banks will report lower cost of funds. But coming into this year, we've seen higher cost of funds, which is triggered by the higher interest rate environment, and that has weighed on most banking earnings, this year. And most banks have also struggled to grow their interest income this year. That's also coming on the back of the flattish loan growth. Coming from a year where most banks, had to grapple with COVID-19. Most of them are cautious in growing their loan book, and that impacted interest income, and also the absence of mark-to-market gains on investment securities as well. Also meant that most banks reported lower interest income. So on an aggregate basis, in terms of revenue, it wasn't a strong year for the banks. Only very few banks, outperformed this year, on a top-line basis. I think UBA, Access Bank, Fidelity Bank were amongst the banks that reported very strong gross earnings this year. The other banks, largely underperformed this year.
So as far as, so then let's now move to cost pressures now. You mentioned cost of funding a moment ago. What other cost pressures were, the sector facing? Yeah,
in terms of cost pressures as well, in terms of their operating expenses as well, we saw them report on higher operating expenses, for most banks. And most of it was regulatory induced. Most banks, most banks report AMCOM charges,
right,
in the first half of the year, and we saw that weigh on their operating expenses, over the first half of the year. But there were a few exceptions, for Access Bank. We all know about the bank's drive to grow their Pan-African business. So for most of the operating costs, we saw most of the operating costs, reported also reflected their expansion drive, as well. And for GTCO as well, the bank is currently pursuing an old structure.
Yep.
So some of the costs in setting up that old structure, also filtered into their operating expenses as well. But on a general scale, most banks reported higher operating costs, due to regulatory induced charges. And we expect that going into the rest of the year, those on a cost-to-income basis, it will moderate over time.
Great stuff. Speaking of regulatory environments, the Monetary Policy Committee, the meeting, they held all rates constant. I hope we can pull up those figures, for viewers. But the cash reserve ratio, 27.5%. Yeah, there it is, 27.5. Is that still weighing on liquidity for the banks?
Yeah, it is to a large extent.
Yep.
Like you mentioned, CRR was held at 27.5%. But when you check the effective CRR, for most of these banks,
yep, it's higher, right?
It's higher, currently ranging, currently hovering around the 40%, levels. And that means that, most banks have their cash sterilized with the CBN, at 0%.
Yeah.
And, speaking to the management of most of these banks, they've alluded to the fact that their earning capacity or their, the ability to grow risky assets, has been largely impacted by CBN sterilization of their funds. So like you mentioned, that largely accounts for the tepid growth we've seen. But we think for us at Chapel Hill, our own view is the major driver of the underwhelming performance, for most of the banks was largely due to the change in the economic environment, other than the CRR charges.
Very quick, Dami, I think we're running out of time. 30 seconds. The fintech players, banking sector and the fintech players, are they a threat? I ask this question all the time. I ask it to everybody. I'll never stop asking this question, but I want to hear very quickly your thoughts.
Yeah, for me, I think it depends on how the bank want to play it. We spoke to management of Zenith Bank, about 2 weeks ago. And the management of Zenith Bank, alluded to the fact that you don't see the fintech players as a threat. And for them, they even see it as an opportunity to grow business as they can serve as bankers to these fintech companies. So for us, we think it will lead to competition, and that competition would would enhance earnings, for most of these brands.
Damilola Lukman, Chapel Hill Denham, thank you so much for joining us.